Okay, so you want to own a building in Manhattan. Maybe you've walked past one. A 6-story pre-war on the Upper West Side, red brick, green awning, a doorman who's been there since 1989. Or maybe it's a skinny 12-story in Midtown, the kind you barely notice between the skyscrapers. And somewhere in your brain, the math seems almost obvious. People pay rent every month, regardless of whether the economy is booming or collapsing. You own the building, you collect the money. Real estate is safe. Manhattan real estate especially. Because they're not making any more of it. That's the fantasy. Here's the reality. Owning a building in Manhattan is one of the most capital-intensive, legally constrained, operationally demanding businesses you can put yourself into. The margins are thin, the regulations are suffocating, and the rules that govern how much you can charge the people living inside your building are decided by a government board that meets once a year. Some of the smartest real estate operators in the world, people who spent decades building portfolios worth hundreds of millions of dollars, have ended up in bankruptcy court. Not because they bought the wrong building, because they believed the math was simple. It is not simple. This video is about what actually happens when you own a building in Manhattan. What it costs to get in, what it costs to stay in, how the revenue actually works, layer by layer, and the specific structural mechanism, a legal clause written into state law that has the quiet power to turn a healthy cash-flowing asset into a slow-motion financial catastrophe. By the end, you'll understand why some of the wealthiest people in the world still buy Manhattan buildings, and why some of the smartest ones have lost everything doing it. Let's start with what you're actually buying when you buy a Manhattan building. Because most people think they're buying real estate. They're not. What you're really buying is access to a rent roll. A rent roll is just a spreadsheet, a list of every unit, who's in it, what they pay, and when their lease expires. That rent roll is the business. The building is the container. The bricks and the boiler and the elevator and the lobby. Those are the factory floor. What you own, functionally, is the right to collect rents from a fixed number of apartments in a fixed location, subject to a fixed set of laws. And those laws determine almost everything. Manhattan has roughly 1 million apartments under rent stabilization. That's not a niche. That's the majority of the city's rental stock. Rent stabilization means the government, specifically, a 9-member board called the Rent Guidelines Board, votes each spring on how much landlords can raise rents the following year. In good years, that increase might be 3 or 4%. In recent years, it's been as low as 0. And expenses, they don't follow any board's vote. Property taxes, insurance, labor costs, utility bills, those go up whenever they want. That gap between income that's capped and costs that aren't is the fundamental tension of this business. Keep that in mind. Everything else in this video flows from it. Now let's talk about what it actually costs to get into this business. The entry point varies enormously by size. A small walk-up, 5 to 10 units, no elevator, a neighborhood like Washington Heights or the lower reaches of the Upper West Side might sell for somewhere between $3 million and $8 million. A mid-size building, 20 to 40 units, an elevator, a bit further downtown, will run you 15 to 40 million. A larger building, 60 to 100 units, in a prime location like the Upper East Side or Chelsea, you're north of 50 million, often well north. And trophy-tier assets, the kind that trade hands between institutional investors, can cross 100 million or more for the right address. These numbers aren't invented. In 2025, the average sale price for Manhattan office and mixed-use properties ran around $495 per square foot, according to commercial real estate data firm Commercial Cafe. For residential buildings, per-unit pricing is the more relevant metric. And for rent-stabilized units specifically, the University Neighborhood Housing Program found that median per-unit prices in Manhattan fell from $290,000 in 2018 to $122,000 in 2024. That collapse in per-unit value tells you something important about the business we're discussing. More on that shortly. For our purposes, let's build a case around a realistic mid-tier acquisition, a 40-unit, 6-story building in a solid but not trophy Manhattan neighborhood. Purchase price, $20 million. At that scale, you're typically putting in 30 to 40% equity and financing the rest, so call it $8 million of your own capital, with a $12 million mortgage. At current commercial lending rates of roughly 6 to 7%, That mortgage costs you somewhere between $720,000 and $840,000 a year in debt service alone, before a single expense gets paid, before a single light bulb gets changed. That's the purchase. Now the hidden costs that hit before you collect your first rent check. Because owning a residential building in New York City is not like owning, say, a house you rent out. It is an intensely regulated commercial enterprise, and the city treats it accordingly. The moment you close on a transaction, you have obligations. First, you need to register the property with the New York State Division of Housing and Community Renewal, DHCR, and register each individual rent-stabilized unit. There are annual registration fees. Failure to register can result in frozen rents, meaning you can't raise them at all, sometimes retroactively. That alone costs owners several $1,000s in legal fees and administrative work to set up properly. Next, Local Law 11, officially the Facade Inspection Safety Program. New York City requires periodic facade inspections for buildings taller than 6 stories. If the inspection reveals defects, and they almost always reveal something, you're required to fix them on a mandated timeline. A full facade repair on a mid-size Manhattan building can run anywhere from $200,000 to over $1 million, depending on scope. You don't choose when. You comply. Then there's Local Law 97, which took effect in 2024. This is New York City's carbon emissions law, and it requires large buildings to reduce their greenhouse gas emissions or pay significant annual fines, up to $268 per metric ton of excess carbon. For many older buildings running on oil or old boiler systems, retrofitting to meet compliance can cost hundreds of thousands of dollars. The city estimates that, citywide, compliance costs across all covered buildings could reach $4 billion. Add to this the standard entry costs, property insurance, which the NYC Rent Guidelines Board found increased 21.7% in a single year from 2023 to 2024. Title insurance, transfer taxes, which in Manhattan run about 1.825% for transactions over $3 million. On a $20 million building, that's $365,000 just in transfer tax. And the mansion tax, which adds another 1% at this price point, another $200,000. You haven't turned a light on yet, and you've already spent over $500,000 in transaction costs alone. Let's get to the revenue, because eventually, yes, rent checks do arrive. In a 40-unit building, you might have a mix of unit types. Let's say 20 studios and 1 bedrooms, 15 2-bedrooms, and 5 larger units or market-rate apartments. In Manhattan, the average rent-stabilized apartment rents for something in the neighborhood of $1,400 to $2,200 per month, depending on size, location, and when the lease was last turned over. Market-rate units in the same building might go for $3 to $4 to $4,500 or more. For our building, let's work with a weighted average of roughly $2,400 per month per unit. 40 units. That's $96,000 per month in gross residential rent, or about $1.15 million annually. That is Layer 1. The residential rent roll, Layer 2. Commercial rent, if applicable. Many Manhattan residential buildings have ground floor retail, a coffee shop, a pharmacy, a dry cleaner. Retail rents in secondary Manhattan locations might run $75 to $125 per square foot annually. A 1,500 square foot ground floor space at $100 per square foot adds $150,000 per year. This is not guaranteed income. Retail has been volatile, and a vacancy in your ground floor space can sit for 18 months before you relet it. But when it's occupied, it's meaningful. Layer 3. Ancillary income. Laundry room revenue, parking if available, storage unit rentals, roof antenna leases from telecom companies. In an older Manhattan walk-up, this might add $20,000 to $40,000 per year. Not transformational, but it compounds. Layer 4, and this is the one most people miss. Vacancy upside. Every time a stabilized tenant vacates, you can reset the rent for the incoming tenant, but only up to the allowable amount set by state law. Since 2019, those rules have tightened dramatically. Before 2019, a landlord could raise rents substantially on a vacant unit. Now, vacancy bonuses are essentially gone. This matters enormously for the long-term math of the business. Total gross revenue for our building, fully occupied, approximately $1.35 million per year. That sounds like a lot. It is not the hard part. Now let's talk about what it costs to simply exist as a building owner in Manhattan, day after day, whether your apartments are full or not. Operating expenses for residential buildings in New York City run, on average, $28 per square foot annually, according to the Building Owners and Managers Association, the highest in the country. In a 40-unit building of roughly 35,000 square feet, that's $980,000 per year in operating costs before your mortgage payment. Break that down and here's where it goes. Property taxes first. Manhattan Class 2 properties, residential buildings with more than 3 units, pay at a tax rate of 12.5% on their assessed value, which the city calculates based on an estimate of the building's income. For a $20 million building, the NYC Department of Finance will estimate an annual property tax bill in the range of $350,000 to $500,000. Let's call it $420,000. That's $35,000 per month, walking out the door before you touch anything else. Labor is next. In a full-service building with a super, a doorman or two, and a porter, you're looking at 4 to 6 full-time employees. Union labor in New York City, and if you're in a larger residential building, you're almost certainly dealing with union labor under Local 32BJ. Means wages plus benefits packages that average over $80,000 per employee per year. 6 employees, roughly $480,000 to $500,000 annually in labor costs alone. Then utilities, gas, electric, water, which the building pays for common areas and often for heat and hot water. Average cost for a 40-unit Manhattan building, $120,000 to $150,000 per year. Insurance. After recent market volatility, budget $80,000 to $100,000 annually. Maintenance, repairs, and contractor costs. The elevators, the boiler, the hallways, the perpetual list of things breaking in a building that was built before most of your tenants were born. Call it $100,000 to $150,000 per year. Management fees, if you use a third-party property manager, typically 4 to 6% of gross revenue, so $54,000 to $80,000. Add it up. Operating costs, not including your mortgage, roughly $950,000 to $1.1 million per year. Mortgage debt service, $780,000. Total annual expenses, somewhere between $1.73 and $1.88 million. Gross annual revenue, $1.35 million. You are already in a fully occupied building with no major capital expenditures, running at a loss. This is what people don't understand about the Manhattan building business at this scale. The operating economics, on paper, look fine until you include the cost of the debt you used to buy it. Here's where it gets interesting and more complicated. The fix, in theory, is to buy a building with enough upside, enough market rate units, enough vacancy turnover, enough commercial income, that the rent roll genuinely covers costs. And for many well-positioned buildings, it does. The wealthier the tenancy, the stronger the market rate component, the better the math. A building in Tribeca with half market rate units and institutional quality tenants produces a very different income statement than a 100% stabilized building in the Bronx. But there's a trap embedded in the business that operates invisibly until it doesn't. And that trap is what destroyed some of the largest landlords in the city's recent history. Here's how it works. From roughly 2010 through 2019, a wave of investors, sophisticated, well-capitalized, often backed by international money, bought large portfolios of rent-stabilized buildings using a specific strategy. The strategy was simple: buy the building, borrow heavily against it, and gradually turn stabilized units into market rate units through a combination of vacancy decontrol and high-income deregulation. Under the old rules, when a stabilized tenant moved out, the landlord could raise rents significantly. Get the rent high enough, over $2,700 per month, and the unit could be removed from stabilization entirely, becoming market rate permanently. This was legal, and it made the math work, because every deregulated unit increased the income the building could generate, which in turn increased the building's market value, which justified the debt. In 2019, the New York State Legislature passed the Housing Stability and Tenant Protection Act, HSTPA. One stroke of the pen eliminated virtually all the mechanisms by which landlords had been deregulating units. Vacancy decontrol, gone. High-income deregulation, gone. The cap on improvement costs you could pass through to tenants, drastically reduced. The entire business model, buy stabilized, lever up, deregulate, became illegal overnight. The buildings didn't change, the debt didn't change, the expenses didn't change, only the income did. And the income could no longer grow the way the underwriting said it would. This brings us to Joel Wiener and Pinnacle Group, because no story captures this structural collapse more precisely. Wiener started buying rent-regulated New York City apartments in the late 1980s. By 1997, he had enough buildings to formalize his operation into what he called Pinnacle Group. Over the next 2 decades, he built one of the largest private residential portfolios in the city, more than 10,000 apartments, spread across every borough except Staten Island. His strategy was the one we just described: buy stabilized buildings, borrow against them, cycle tenants, deregulate units, and watch the asset appreciate. To fuel the expansion, Wiener went to international capital markets. His holding company, Zarasai Group, issued shekel-denominated bonds to Israeli investors, a common financing structure among New York landlords seeking cheaper debt. At the peak, more than $1.1 billion in total obligations were tied to his portfolio. Flagstar Bank held $564 million in mortgage debt. Israeli bondholders held the rest. When HSTPA passed in 2019, the model broke. Expenses kept rising. The NYC Rent Guidelines Board's own data shows operating costs for stabilized buildings rose 28% between 2020 and 2023. But rents approved by the board increased only 10.5% over the same period. Interest rates then doubled, from around 3% in 2022 to 6 or 7% by 2024, making refinancing almost impossible. The cost to cover debt service on Pinnacle's portfolio skyrocketed by 75% in just 2 years, according to Wiener's own court filings. By early 2025, Flagstar Bank had filed pre-foreclosure actions against roughly 5,200 units. In May 2025, Wiener put 82 holding companies, representing 93 buildings and approximately 5,200 apartments, into Chapter 11 bankruptcy protection. The portfolio that Pinnacle had valued at $826 million on its own balance sheet sold in January 2026 for $451 million, a 45% discount. Flagstar, which had lent $564 million against these buildings, recovered far less than it was owed. The bank is expected to absorb a loss of over $100 million. Tenants in dozens of buildings had been living for years with broken elevators, mold, and boilers that failed in winter. Housing code violations deemed immediately hazardous at Pinnacle properties increased fourfold between 2019 and 2024. This is not a story about a bad person making bad choices in a vacuum. It's a story about a model that worked under one regulatory regime and collapsed completely when the rules changed. And it's a story that played out across the sector. By early 2024, pre-1974 rent-stabilized multifamily buildings had a financial distress rate of 25% by loan balance, according to ratings agency Kubra. Greg Corbin, president of Northgate Real Estate Group, which specializes in distressed building sales, estimated in 2026 that at least half of New York City's predominantly rent-stabilized buildings are now financially troubled. Let's now run the numbers side by side. A good year and a bad year. For a well-positioned Manhattan building, using everything we've established. Same building, 40 units. A mixed portfolio, 30 stabilized apartments averaging $2,200 per month. 10 market-rate apartments averaging $4,000 per month. Ground floor retail space occupied. No major capital expenditures this year. The good year. All 40 units occupied. Retail tenant paying $12,500 per month. Ancillary income, laundry, storage, adds $3,000 per month. Total gross monthly revenue, $103,500. Annual, roughly $1.24 million. Operating costs, taxes, labor, insurance, utilities, maintenance, management, come in at $950,000. Mortgage debt service, $780,000. Net, negative $490,000. But wait, this is on a leveraged purchase. The actual cash yield on equity is what matters. On $8 million of equity invested, the building's net operating income before debt service is roughly $290,000, a 3.6% cash-on-cash return. Not thrilling, but positive. The value thesis here is appreciation. You're not getting rich on income, you're banking on the building being worth more in 10 years. The bad year. 3 units vacant for 6 months. A stabilized tenant passes away. 2 market-rate tenants relocate. Retail tenant breaks their lease in month 4, and you spend 8 months finding a replacement at lower rent. A boiler inspection reveals a required replacement. $180,000, not covered by insurance. The NYC Rent Guidelines Board freezes rents for the year, as actually happened in Manhattan in June 2026, when the board voted a rent freeze under political pressure from the newly elected mayor. Revenue drops to roughly $970,000. Operating costs with the boiler replacement run $1.13 million. Debt service, $780,000. Cash shortfall, $940,000 against your full cost structure, and your net operating income before debt is now negative $160,000. The difference between those 2 years is $1.43 million. One is survivable if you have reserves and a low debt load. The other, with heavy leverage and no cushion, is the beginning of the spiral. So why do wealthy, sophisticated investors still buy Manhattan buildings? If the margins are this thin, if the regulatory risk is this real, if the case study above is the cautionary tale playing out at scale right now, why does anyone do it? 3 reasons. First, appreciation. Manhattan real estate, over long enough time horizons, has historically increased in value even when it's not cash flowing. The city is geographically constrained. You cannot build west into the Hudson River, and globally desirable. For investors with long time horizons and low leverage, the building doesn't need to make money every month. It needs to be worth considerably more in 20 years. Second, depreciation and tax strategy. The IRS allows real estate owners to depreciate the value of their building over 27.5 years, creating a paper loss that offsets income from other sources. A $20 million building with the structure allocated at, say, 80% of value generates roughly $582,000 in annual depreciation deductions. For a high-income investor, that tax shelter is worth hundreds of thousands of dollars per year in reduced tax liability. The building doesn't need to profit much. It needs to anchor a tax strategy. Third, scarcity and leverage. Manhattan addresses are finite. Owning one isn't just an investment, it's a position. For family offices, institutional investors, and international wealth seeking a hard asset with global liquidity and cultural prestige, a Manhattan building functions less like a bond and more like a Picasso. The income matters less than the ownership itself. But here's the thing, nobody tells you when you look at those reasons. All 3 only hold if you survive. Appreciation is meaningless if you're in bankruptcy court by year 6. Depreciation deductions evaporate when the lender forecloses. Prestige is cold comfort when you've burned through your reserves paying for a boiler you didn't budget for. The investors who thrive long-term in Manhattan residential real estate tend to share 3 characteristics that are unglamorous to the point of boring: low leverage, patient capital, and genuine expertise in the regulatory environment. They don't bet on law changes they can't control. They don't project income that depends on rules staying the same. They stress test their models against the bad year scenario and make sure they can survive it. Here's what nobody talks about when they talk about owning a building in Manhattan. The building is not the asset. The rent roll is not the asset, exactly. The regulatory environment. The set of laws governing who can live there, what they can be charged, what you're required to provide, and how all of that can change, is the single most important factor in the value of what you own. Which means the most critical document for a Manhattan building isn't the deed, it's the lease register filed with the DHCR. It's the unit-by-unit history of every rent increase, every major capital improvement, every renovation that was or wasn't done in compliance with the law. Because a documentation error, a missing form, a misapplied rent increase from a decade ago, can trigger what's called the default formula, under the rent stabilization code, automatically resetting rents to the lowest comparable unit in the building. Since 2023, that risk now extends even to lenders who take over properties in foreclosure. Banks themselves can be trapped in a regulatory system they didn't underwrite. This is why the Pinnacle story isn't really about Joel Wiener. It's about a fundamental truth. In Manhattan real estate, the government is your silent partner. A partner who sets prices, caps your income, mandates your expenses, determines your tenants' rights, and votes on your business model every spring. You don't get to renegotiate. You adapt, or you absorb the loss. The bricks hold the building up. The law holds the math together. And in Manhattan, the law always wins.